In this episode, I discuss how numbers lie, especially in the financial world. Why you shouldn't invest money solely on projections, and why in the infinite banking community, policy illustrations should serve a very minor role in your decision-making process. I'm Nate. I make sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. All right, everybody, welcome back to the show. It's great to have you. As I've mentioned before many times, algorithms love ratings and reviews. If you would be so kind to leave us a subscription on YouTube or a like on the video or rate and review on Spotify or Apple Podcasts, wherever you consume the content, it would mean the world to us as we really do try to produce the best content in the infinite banking footprint. And so we're going to dive in today on something I've mentioned this before a few times, but I believe in the financial world, numbers can so easily lie to us, especially whenever they're dealing with projections. And fundamentally, I believe, so the whole podcast show is going to be based on this. I believe that people make financial decisions based on ideas, based on concepts that they understand, and trust that they have with people. They don't make financial decisions based on numbers or projections. And that is exactly how it should be. From being in the infinite banking community, you'll hear people asking you about the numbers. Show me the numbers. I want to see the numbers, as if the numbers are actually what is going to be the determining factor for anything in the financial world. And so I'm going to flesh this out in this episode. That I believe that in the financial world, you should not invest money in a deal based on a projection in a vacuum, based on the numbers on a spreadsheet that some investing guy sent you. Do not base your decisions on numbers, because that is essentially the same thing as you allowing yourself to get your ears tickled. And we've mentioned this on the show many times, that people lose money and make mistakes when they don't put money in things that make sense. They instead just let their ears get tickled, normally chasing high rates of return. In other words, they got pitched an investment opportunity where the guy pitching it presented this high rate of return that was possible, and you said, sign me up, and you didn't use the fundamental, deeper things that are how we actually make decisions. So we've talked about this and how numbers can be deceptive quite often. You know, if you go back to some earlier episodes on this show, we've talked about how there's actually a huge difference between stock market actual returns versus average returns. Like, in other words, a stock mutual fund group or something can say, we've averaged a 10% rate of return over the last 5 years. You should come put money with us. Once again, trying to tickle your ears with numbers. And numbers lie. And so they could say we've had this average return that's looked really good, but in actual returns, you could technically have lost money even though the return, the average was 10%. And we've talked about this before, just to do a quick little synopsis of that. If you put in $100,000 into an investment and it increases by 50% one year, you'd have $150,000. And then if it loses 50% the next year, you would be actually down to $75,000. So your 100 will have lost $25,000. But if you ask them what the average rate of return is, it's zero. Technically, the average rate of return was 50% one year, down 50% the next year. The average rate of return is technically zero on the deal, but you actually lost 25%. That's why I'm saying numbers lie in so many ways. They're so deceptive in so many ways. The same thing goes for real estate projections. I love real estate. I think people should own a lot of real estate. I think they should invest a lot of money in real estate. I'm just merely saying that if all you were to do is wait for some real estate syndication group or some real estate fund to send you a projection of possibilities, I hope you understand that those projections are worth the same amount as the paper they were printed on. That's it. The number that they assume you can make is just there to tickle your ear. What are you actually agreeing to? The number can't show you if it's a good deal. Because they can print whatever they want in the projections. There's so many variables in, let's say, a real estate deal where if any of those change, the numbers change dramatically. Most of the time, the projection, a real estate projection will assume some rosy results. And they might be likely and they might not be likely, but you need to figure that out. That's why we talk about becoming an A player. It's impossible to decide between two alternatives based on numbers. So here's where it comes down to. Projections are worthless unless you understand what's going on underneath the numbers. What you're actually buying is whether or not you believe that the projections are likely or unlikely. So it's impossible to decide between two alternatives based on numbers. We actually use deeper realities to make decisions. You are actually using something more primal, something deeper than just simply looking at a set of numbers. Don't let the numbers tickle your ear. That's how people get burned. Every client I've ever had who has lost money making investments oftentimes does not understand what's going on. They just send money to somebody because that person said they can make a lot of money if they sent it. And they got a projection and there was a sheet and it showed all this money being made and they lost everything. And you're sitting here thinking that's because you made a mistake. You bought something based on numbers. You bought something based on projections. You ignored the deeper fundamental decision-making reality that you should have listened to in the process. So this is the idea. Let's say you're getting pitched two different investment types, and one is showing you a 12% rate of return, and one is showing you a 14% rate of return. Which one are you going to choose? I really hope that the answer is not the 14% rate of return one. I'm just merely saying, I hope that in the vacuum, and just by me essentially asking you this, you have a 12% rate of return or 14% rate of return, which one are you going to choose? I hope you can start to see the logical conclusion, which is, how am I supposed to know yet? How am I supposed to know? I need to understand the deals to understand which one I actually want to do. That's because the numbers don't mean anything. The numbers exist only to confirm the concept that the person is presenting. You are going to put money, this is what you're actually going to do. This is how decisions should be made and how they are often made. And all the bad decisions you make are not based on what I'm about to say. So here's how they should be made. So somebody offers you a 12%, somebody offers you a 14%. You've got $100,000 and you've got two options to put it in. You're going to make the decision of which one to go with based on a deeper reality, based on essentially a conceptual reality. Which one of these investments do I think is likely to achieve what is being projected? That's what you're deciding. Do I believe in the person who's offering me the investment opportunities? Do I believe in their ability to achieve what they're projecting? Do I believe that the economic forces that exist in the macroeconomy are going to produce the desired results? Do I think the microeconomy of the area, if it's a real estate property, let's say, do I think that the area that they're choosing, do I believe them that that's a good area to buy right now? These are the deeper realities that you are actually going to use to piecemeal together which option makes sense. Because the reality is the 12% one could be a guy who's offering you projections in a very conservative way. He's like, we're using conservative projections. While the 14% guy could be using very aggressive projections. So the numbers are deceiving you. They don't mean anything. Your actual decision, the deep down primal decision-making factor that's going to help you choose correctly, is going to be the one that, which deal do you believe is likely to work based on fundamentals, not based on the numbers on the page. The numbers are just supposed to prove to you if the fundamentals are true, what the end result is going to be. Let me repeat that. The numbers on the projection in anything financial are there to prove to you that the concept, the fundamentals, the idea behind the investment is going to work out. And if you believe that it is, then here's what it's going to look like. You should not base your decision on the numbers. It should be based on the fact of whether you believe the idea and the fundamentals are true. And the same thing happens in the world of infinite banking. Oftentimes, people decide to do the infinite banking concept based on fundamentals, not on life insurance illustrations. And I want to make this crystal clear. Many people come to me asking to see the numbers. I want to see the numbers. Let's run an illustration. I want to see an illustration. The numbers exist only to either prove or disprove the fundamentals. You are buying the concept. You are buying the fundamentals. The life insurance illustration should only either prove or disprove to you the fundamentals. So I believe people make financial decisions based on ideas, concepts, fundamentals, not based on numbers or projections. That's how it should be. Let me dive into this a little bit more in the world of the infinite banking concept. So that's certainly true everywhere in the financial world, where you should not let your ears get tickled by some sort of fancy projections. They are worthless. You should actually decide where to put your money based on fundamentals. The projections are only there to show you what happens if the fundamentals are correct or not. In other words, the numbers should just be there to be confirmation of what you assumed. And the same thing is true in the infinite banking concept. The illustration, the policy illustration, when you actually review some numbers, it's a projection. It should be the final confirmation of what you already know to be true. You should, by the time you look at a life insurance illustration, you should already know whether you believe that it's going to work or not. And this serves as the final confirmation to you. So most people, let me just kind of go back to where I was. Most people, when they get introduced to IBC and they're kind of learning about it, they think it sounds good, but they're like, I got to see the numbers.
The conventional financial system makes the bank rich using your money and pays you next to nothing in return. At Living Wealth, we believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to become your own bank. Visit livingwealth.com/bank on yourself. You'll receive instant access to what we call the beginner's course. This free, in-depth, easy-to-follow course teaches people how to create and profit from infinite banking. We not only discuss the philosophy and principles behind infinite banking, but also offer real-life examples to demonstrate how it works. Even participants experienced with infinite banking often tell us how they learned a ton too. It's worthwhile regardless of your experience level. Stop letting the banks and Wall Street dictate your financial future. Again, that's livingwealth.com/bank on yourself to gain access to the free course today. Now back to Nate and Holly.
I want you to know the numbers. I want you to know what they look like. I want you to know how to read an illustration. So I'm not trying to bypass the point. What I'm trying to bring up is that you are about to make a decision that is going to be based on fundamentals. By the time you actually get to an illustration, the illustration should serve a purpose. The purpose should not be to prove to you the system works or not. You should already believe the system will work, and the numbers should just be the final confirmation. That's a wise decision. And that would be the case, it doesn't matter if it's policies or anywhere. In any investment, whether it's in building your banking system through policies, or whether it's in real estate, whether it's in the stock market, whether it's in Bitcoin, whether it's in gold, you buy the fundamentals. I mean, if you're listening to this, you've listened to many podcasts. You've taken our beginner's course online. You've probably watched our videos on YouTube. Maybe you've seen some other people's stuff, and maybe you've read Nelson Nash's book. You've gone through this process of educating yourself to determine whether you believe that building a banking system through dividend-paying whole life insurance policies is going to produce for you more profit and higher amounts of wealth than if you continue to use the default banking regime of checking accounts, savings accounts, and bank loans. This is the decision that stands before you. And you've gone through all this research to determine whether you believe that using policies is going to produce better results than using bank accounts. That by the time you get to an illustration, you should have already believed in this as a banking tool. And the illustration then is just supposed to teach you how the policy design is going to look, some different factors about it. But what I'm surprised is some people, they get to the policy illustration and they go back to commodity mode of just like making a decision based on some sort of of cheap buying transaction. And I'm saying, no, there should be no curveballs the vast majority of time. In a policy illustration, you should kind of know what to expect. You should expect to see premiums going in. You should expect to see premiums going in for a long period of time. You should want premiums to go in for a long period of time because you want to have a big banking system. You should expect to see the policy cash value not equal premiums paid for a period of time. You should expect the cash value to exceed premiums paid over a period of time. You should expect to see a long-term compounded trajectory over a period of time. You should expect to see a good death benefit and legacy for your family. You should expect to see dividends being paid and guaranteed growth occurring underneath the hood. And you should expect to see that the result's probably going to produce a policy that produces 4 to 5% increases over time due to the growth of the policies in the current environment. That's what you'll see. The policy illustration confirms all of this. That's all it's supposed to do. Because what you're actually then going to use the policy to do is become your own banker. You're not buying a policy as an investment to set money into it. You're using it as a banking tool. Once you see the illustration, you need to go back to the fundamentals and realize, yes, this is exactly what I expected to see. This makes sense. Based on all the things I've learned, this is exactly what I expected to see the policy illustration to show me. That looks good. I'm going to use this policy that is being illustrated by an illustration that is a projection to become my own banker. And I'm going to pour money into this, and I'm going to borrow against it. I'm going to do all the things that I believed during my investigation phase of what life would look like as my own banker. So if we go back to my guy, and they've gone through all this process, and then you go over a policy illustration with them and kind of describing, and they end the meeting by saying, well, let me just review this, got to make sure the numbers make sense for me, blah, blah, blah. I'm like, what are you actually deciding at this point? That's my question. In other words, what is on this page that's going to help you decide whether you want to become your own banker? What on this page is illustrating something that was missing during the 50 podcast episodes, the beginner's course, the YouTube, the books, the hours of time you spent reading? What on this page is going to show you something you don't know yet? I hope that's actually not occurring. That's actually what's occurring, though, in the infinite banking footprint in the YouTubers, the marketeers, the marketing guys out there who they just want you to buy a policy. Like they are just selling the policy as a policy. And that's why I'm upset with them. They don't actually teach people the concept that Nelson Nash promoted based on fundamentals. They're just simply saying, hey, policies produce good rates of return. It's safe. It's liquid, tax-free. You want to put some money in. Here's what it looks like. Does this look good to you? You want to invest some money in this? Okay, good. Let's sign on the dotted line. And that's the whole relationship. I'm like, no, remember, if you're going to work with me, you're not agreeing to buy a policy. You're agreeing to become your own banker. That's what I do. So Nate helps people become their own banker. That's what our team does. We help people become their own bankers. We are not peddling life insurance policies as investment tools. So I think what people are looking at is to determine if the policy is going to produce for them a high enough rate of return or something like that. But in other words, they are going to throw away all the fundamentals that got them there to then look at a life insurance illustration to see if they think the numbers produce on the page a high enough rate of return in order to invest money in a policy. But they know, deep down they know, that they're not actually going to use this policy as an investment, that they're going to use it as a banking tool. Deep down, they know. But they've never made a decision like this, I guess, or something like that, so they get tricked again. So they think that they're actually investing money in whole life insurance policies, and they're trying to use the numbers to determine if the rate of return is high enough to offset, some other thing they can put their money into. And what we're saying is, I thought you came to me because you wanted to become your own banker. So I'm not trying to be offensive. I'm just merely saying I think that we get so convoluted in the last 25 episodes, as I mentioned last time, last 25 episodes are just trying to fine tune the proper perspective someone has to have in order to successfully implement the infinite banking concept. Sometimes what you tell me, what you decide, your questions asked oftentimes reveal perspectives. Sometimes that perspective will not align well with infinite banking. It's not like Nate's opinion just won't align. The perspective you have yet means that you don't understand enough about the fundamentals to be buying a policy yet. Like you're actually seeing the policy as a very transactional, commoditized thing as opposed to a banking system. So the policy should confirm what you already know. So that's the idea of the rate of return mentality is very common, of course. And, Nelson Nash even wrote about it in his book when he says the most common thing voiced when determining whether to do IBC is but what if I could get a higher rate of return? Should I still put money in policies if I can get a higher rate of return elsewhere? And as Nelson Nash describes, and as we've described on the show, and as everyone's trying to describe, the idea of IBC is not about investing money in life insurance. It's not an investment. It is a banking system that we're establishing that will then finance the various investments and capital transactions of our lives. The true decision that you need to make is whether you believe that building your life around dividend-paying whole life insurance policies as your banking center, and then using that banking center to finance the various investments, business dealings, personal items that are going to come your way, you need to decide whether you believe it's likely that that is going to produce better results than doing the default banking regime methods of checking accounts and savings accounts. And we need to go back to determine whether you believe that. You need to determine whether you believe the fundamentals of the concept that we've been teaching. The idea that banks are out to get you. The idea that you make deposits, the bank lends your deposits out, they pay you one rate and they keep the rest. It's a con game. They're a con artist. It's the greatest con game ever. And that we tend to use banks as capital reservoirs when we shouldn't be, because they're stealing money that's rightfully ours. Our money is earning the banking world a lot of money. The banks are taking it. We're allowing them to take it. We believe that dividend-paying whole life insurance policies present another alternative, a different alternative where the entire banking regime can profit you as a policyholder and owner of a company as opposed to a bank. So we're saying that by default, fundamentally, it would be unlikely for a banking world, the default banking regime, to produce better results than the policy situation based on fundamentals. If you agree with us all along the way, then the policy illustration should serve as the final confirmation. In other words, you understand what it's going to be like owning a policy. You understand how much money is going to be available over time. So the theory implies that banking from policies is going to work out. And as I've said before, the numbers will back that up in 9 out of 10 situations. There are occasionally situations. I did a podcast, I can't remember the episode number, but I did a podcast. It was the podcast where I talked about other people who were kind of attacking IBC and criticizing IBC. And I discussed that you can actually come up with a situational reality in which IBC doesn't really help you very much. The numbers would prove in 9 out of 10 situations that IBC is a better way forward for you, not based on the numbers per se. The numbers just prove the idea that we already believed. So what you'll find though, and as we're wrapping up now, is that there's a kind of an additional wrinkle to all this, is that some people who say they believe it to be true, they must not actually believe it. Because they're not living it out. Your faith is always revealed by your works. And so what you'll find is somebody who says, I do believe that policies are a better banking situation than the default mechanisms, yet they still rely almost solely on the default banking mechanisms. Like they have all their money over there. They got a policy, it's got some money in, but they got all their other money in banking, conventional banking things, and they're using the banking things for everything. So what I'm saying is there's actually some sort of disconnect. What you say you believe, you're not acting out. You're not living it out. Once again, this is a no judgment zone. I'm helping people think of where their perspective is and how to grow. And so what I'm saying is you have to choose what you believe. Some people will say, okay, I believe it, but I'm not willing to actually live it out. That's fine, and it's going to take some time for everybody to grow in comfort levels to get there. But at some point, you really got to make a decision whether you believe that the banking system through dividend-paying whole life is something that you really want to go after or not. And if you really want to go after it, then let's go. If you don't really want to go after it, that's fine. I want you to make decisions based on the proper decision that you're making. There needs to be something deeper, conceptual, some idea, some trust with somebody. Like in other words, if you trust that they've done a whole bunch of real estate deals and they're doing a great job, you look at the fundamentals, you look at the person, and you start to trust that, I think that what he says is going to turn out because I trust him. So there's concepts, there's trust, there's fundamentals that should all take place before you see a projection, and then you make sure the projection aligns with what you already believed would likely happen based on fundamentals. I hope this has been helpful. I hope this might save some people from losing some money in the investment world. It happens all the time. Don't let your ears get tickled. The numbers don't mean anything. All right, guys, this has been Dollars and Nonsense. If you follow the herd, you will be slaughtered.
One last thing before we go. Start your journey towards financial security and wealth today. Visit livingwealth.com/bank on yourself. Upon completing the course, you'll have all the information you'll need to see if infinite banking is right for you. Again, go to livingwealth.com/bank on yourself.